Looking at the Bajaj Finserv Q4 FY26 reporting document, consolidated total income grew by 6% to 38,508 crore rupees. Further down, consolidated profit after tax grew at 5% to 2,539 crores. On the surface, these single-digit figures suggest a deceleration in growth. That headline read is incomplete. A deeper look into the insurance subsidiaries reveals that a substantial portion of revenue is tied up in investments held at fair value through the P&L. Recent geopolitical tensions triggered temporary mark-to-market, or MTM, losses on these portfolios. This chart maps out the discrepancy. If we gross up the MTM impact, stripping out those temporary market fluctuations, the underlying operating reality looks very different. Core adjusted revenue actually grew by 14%, and adjusted profit after tax expanded by 24%. To bridge this gap between the statutory P&L and the actual economic run rate, we need to deconstruct two specific areas: the short-term underwriting variances in the insurance businesses and a major capital restructuring involving Allianz. For institutional investors, the strict mechanics of statutory accounting are currently masking a highly efficient underlying operation. Let's isolate the noise. This regulatory filing from March confirms a structural shift. The insurance subsidiaries, Bajaj General and Bajaj Life, completed the buyback of the remaining 3% stake held by Allianz, bringing the businesses to a 100% domestic ownership structure. The resulting equity is now split entirely within the group: 77.33% held by Bajaj Finserv, 18.1% by Bajaj Holdings, and 4.6% by Jamnalal Sons. This transaction required immediate capital. As noted in this performance breakdown, the general insurance arm absorbed a one-time impact of 1,590 crore rupees, which temporarily depressed both its total assets under management and its overall solvency ratio. A parallel capital outlay occurred on the life insurance side. The transcript notes a similar reduction for Bajaj Life, impacting its AUM and solvency by 1,200 crore rupees. These immediate reductions in solvency margins are accounting realities of a cash buyout. They do not indicate operational weakness or underwriting losses. Management traded a portion of their short-term surplus capital to secure absolute equity control. By consolidating ownership, they have concentrated the future return on equity and return on embedded value entirely within the group. Looking closely at the general insurance results, we see an underwriting loss of 96 crore rupees for the quarter and an elevated combined ratio of 113.6%. Two specific timing variances skewed this ratio. First, the company executed a new reinsurance treaty on its government health business. Because this was applied retroactively to the third quarter, it depressed the net written premium recorded for Q4. Second, government health schemes inherently feature higher loss ratios in their initial months before tapering down. The Q4 figures absorbed this upfront claims pressure. Meanwhile, as this section of the transcript details, management made tactical decisions to reduce their exposure to the crop and motor sectors in response to severe pricing pressure in the broader market. When we nullify the impact of these short-term timing variances and review the full-year basis, the normalized combined ratio sits at a healthy 101.90%, remaining highly competitive within the industry. The choice to walk away from unprofitable crop and motor premiums while absorbing the accounting impact of the retro treaty proves a strict adherence to underwriting discipline over raw top-line expansion. A similar discipline is driving the life insurance subsidiary, executing a multi-year transition branded as Bajaj Life 2.0, which prioritizes sustainable and profitable growth. This document breaks down the resulting retail-weighted received premium product mix. It is highly balanced, with participating products at 25%, non-par savings and annuity at 24%, and ULIPs at 42%. That optimized mix translated directly to the bottom line. The value of new business surged 29% for the quarter, reaching 709 crore rupees. Simultaneously, the net business margin expanded to 24.5%, an absolute increase of 2.4 percentage points from the same period last year. Crucially, as noted here, this margin expansion was achieved while fully absorbing a gross 5% impact from recent regulatory changes to GST. By actively managing their product mix and driving strong renewal premiums, the business generated enough internal momentum to digest a significant regulatory headwind without sacrificing profitability. Beyond the insurance operations, the core lending engine continues to operate at a massive scale. During this quarter, Bajaj Finance crossed a historic milestone, pushing its assets under management past the 5 lakh crore rupee mark. Even while booking 1.29 crore new loans in a single quarter, the company maintained pristine credit quality, with net non-performing assets holding at just 0.4%. At this volume, the group's aggregate performance exerts a gravitational pull on the broader Indian capital markets and institutional exchanges. To unify reporting across these massive subsidiaries, this regulatory filing outlines the accounting roadmap. The insurance companies will seek a 1-year regulatory forbearance, planning a full transition to Ind AS accounting standards by April 2027. Once that transition is complete, the disconnect between statutory reporting and underlying economics will narrow. Q4 served as a period of proactive balance sheet cleanup, clearing out legacy stakes and optimizing portfolios. The optical deceleration in headline profit is a temporary artifact. Beneath the surface, high-conviction capital allocation and conservative reinsurance accounting have primed the foundation for unencumbered, highly concentrated growth.